Hello and welcome to this TMI webinar, ETDA, What Next? Transitioning to Electronic Trade Documents in association with ARKit and SureComp. I'm Ben Poole from TMI's editorial team, and today I'm joined by Enno Burkhard-Witzel, SVP Strategy, Digitization and Business Development at SureComp, Dominic Broom, SVP Working Capital Technology at ARKit, and Chris Southworth, Secretary General, ICC UK. So let's start by going around the table with a very brief introduction from each of you. Chris, let's start with you.
Hi there, I'm Chris Southworth, and I probably have a few roles in the context of this conversation. I'm the Secretary General of the International Chamber of Commerce and co-founder of the Centre for Digital Trade and Innovation in the UK, but I'm also the co-chair of the Commonwealth Digitalisation and Legal Reform Programme and a member of the Legal Reform Advisory Board at the ICC Digital Standards Initiative.
Thanks, Chris. Dominic, over to you.
Yeah, good morning, everybody. Dominic Broom, a reformed banker and been in the world of fintech for the last 5 years. The subject that we're talking about today is something very close to my heart. Actually, I will credit my friend Chris Southworth for getting me involved in trade digitization about a decade ago when, as the ICC UK's delegate to the ICC's Global Banking Commission, he persuaded me that we should start thinking about digitization in the context of legal reform. And, the wonderful result is that legal reform now being implemented. Looking forward to a good discussion today.
And Enno, let's hear from you as well.
Hey, I'm Enno Weitzel. I'm heading strategy at SureComp, ex-banker before, consultant before, now working on the good side of things. And our Revo platform basically enables all trade participants to seamlessly collaborate in all trade instruments. And that seems to be instrumental to get things started.
Fantastic. Thanks all. So let's kick off the discussion. And I'd like to start by kind of looking at the importance of having a legal basis for digital trade. Chris, I'll come to you first. For those viewers that perhaps might not know, can you give us a brief introduction of what the Electronic Trade Documents Act, or ETDA, actually is?
Yeah, so at global level, there's a big drive now to ensure that the global trading system is fully paperless, fully digital, and to do that, there are effectively two sets of barriers. The first being legal. In most parts of the world, documents of title, that's bills of exchange, bills of lading, warehouse receipts, promissory notes, the documents that relate to the possession of goods and the transactions of the goods are on paper. And so the global campaign is to digitalize 60 to 80% of world trade by 2026. And that includes removing all the legal barriers and aligning our legal systems to what's called the UNCITRAL Model Law and Electronic Transferable Records, MELITA for short. Now, the UK, we kicked off that exercise about 5 years ago and then partnered up with the Law Commission for England and Wales and the UK government and Parliament. And the fruition of that work was the Electronic Trade Documents Act, which came into force in September 2023 this year. And what that does is effectively recognize documents of title in digital form. So it doesn't say no paper. It actually just updates the existing law, which is the Bills of Exchange Act 1882 and the Carriage of Goods by Sea Act 1992, and brings it up into the modern age, which obviously is digital, by recognizing these documents in digital form.
Thanks, Chris. And Enno, as Chris alluded to, the ETDA hasn't happened in isolation. Could you give us some context around how it fits into the overall global movement to provide that legal underpinning to digital trade instruments?
Sure, happy to do so. So when Chris alluded about putting MELITA into national legislation, that is a milestone. Because so far the initiatives to digitize paper or move away from paper towards digital instruments was lacking scale. Any initiative was lacking scale because the transaction costs to effectively work on any of such solutions were prohibitive. Because the trade finance instruments, in essence, exist to bridge the trust gap, right? So the missing trust between the supplier and the buyer. Now, the key benefit from paper is its universal interoperability. We might not like it, but it's real and it's valid in court. Hence, if we want to replace paper, and that's the two elements that Chris also mentioned, right? We need to have an instrument that can work in court. Mm-hmm. And as long as you don't have a national law that equates paper to digital instruments, you need to invent a club that basically says within that club, we agree to use digital instruments equivalent to paper. And within that club, you can work on an electronic bill of lading or a bill of exchange or a digital guarantee. So you need to have a rule book. Now, having that rule book and not a national law sets a barrier to adoption, because you need to, if you want to adopt, you need to go through choose a digital platform. You need to trust that the digital platform will prevail and not go down. You need to understand the rule book. You need to trust that that rule book will be valid in court in case, going back to the missing trust, there will be a lawsuit. And finally, you need to convince your internal departments like legal, compliance, purchasing, sales, etc., and your counterparts to join the platform. Now, you can easily imagine that as a sum is prohibitive, right? Mm-hmm. So in contrast to facilitating digital records in national law, the only thing you have to do is check whether the transaction is based on a jurisdiction that has implemented MLETR in national law, and you can go, right? So this is really fundamental what Chris and the team have been doing in the UK.
And we've had digital trade instruments in some form or another for a little while at this point. Dominic, I want to bring you in here. In that context, why is the launch of the ETDA so important, particularly for the corporate treasurers that will be watching us this morning?
And it boils down to one word at the end of the day: efficiency. Mm-hmm. Whilst the physical movement of goods has become markedly more efficient over the course of the last half century or so, mainly as a result of containerization, documenting and financing global supply chains, as Chris was saying at the outset, remains inefficient, largely paper-based, and that often results in goods being delayed in transit, or from the perspective of corporate treasurers, lengthy payment cycles that can leave businesses struggling to manage their working capital efficiently. Mm-hmm. Now, the passing of into English law of the ETDA heralds this new dawn for international trade by simplifying trade processes and supply chain processes and making working capital finance in particular more accessible to a wider range of buyers and suppliers. And how's that done? Through the legal recognition of an electronic trade record, and that lays the foundation for businesses to think and act differently to make trade cheaper, safer, more efficient, with these electronic equivalents of paper trade instruments enjoying, as Enno said, the same legal treatment, effects and functionality as their paper equivalents. And all of that in statute law with no longer reliance on what I would refer to as a sort of closed user structure of a private law contract. The law in itself is helpfully short and concise, reflecting the essence of the 2017 model law on electronic transferable records. And that's important because that's law that's already been adopted by Singapore, the UAE, amongst others, and will form the root of similar legislation being adopted by G20 nations. So you'll get that legal conformity across large trading nations, ultimately all trading nations, and that's critically important.
Fantastic. Thanks, Dominic. Chris, you obviously speak to a lot of corporates in your line of work. So what's top of mind for them when you speak about them considering engaging in the digital trade space?
Well, I think it's fair to say that the corporate community probably hasn't been as engaged as perhaps the other actors in the trading system. And that's part of the reason why it's such a big priority now. Being the cargo owners and the buyers and sellers of goods, they are the critical parties in enabling all of this to happen. The feedback we're getting from corporates is, from a treasury point of view, corporate finance point of view, there are sort of three things on people's minds is the feedback we're getting. One is liquidity, two is risk, and three is profitability. And of course, we're living in a world where companies are looking for agility, resilience. There's obviously risk out there in the system, but also looking for a cost and efficiency and means to reduce risk, whether that's fraud, loss and damage of documents, delays in the system. The good news is that this is a solution to all of those things, but we do need to start to learn to engage with the corporate finance teams, speak the language that the corporate finance teams use and work much more closely with the banks as well. The benefits, which we'll talk about it in a little while, are really compelling. An overwhelming case, I think, business case for action here. But our job now is to really transmit that and communicate that clearly and succinctly to the corporate finance community.
Great point. And TMI actually ran some LinkedIn polls for treasurers around today's topic, which some of you may have seen over the past week or so. And when we were looking at the biggest trade and supply chain challenges that treasurers are facing right now, process efficiency and visibility and working capital management came out as kind of joint leaders in the challenges, both taking about over a third of the votes each. So, Enno, from your perspective, what are the main challenges that corporates might encounter when preparing to switch to digital trade?
Well, as I said, switching to digital trade is a change. So a change requires all the typical change management, starting from senior management support through aligning on the targets and all the way to empowering the people. And as you just mentioned from the poll, right, you can increase your efficiency for cost reduction, you can improve your working capital management, or you can improve your turnaround time to win new business, or you can even advance the job profile of those people working in the trade finance teams to attract new talent. So all targets, all goals are very different and it would require individual motivation to get the whole organization there, right? So some of the pitfalls or challenges is, let's not aim for the perfect process when turning digital. You may want to change an old cumbersome paper-based process with, now that you can go digital, a fully automated ideal digital flow. Now that is basically set for failure, right? So learning from the past, it's recommendable to start with a meaningful piece within your organization and eventually a friendly counterpart that you can oversee and quickly see the benefits that Chris already indicated. And then have that 80-20 rule in mind. So trying to achieve 80% of the benefits with a very minimal or even that 20% effort, right? And then gradually build the trust in that new processes. And lastly, you need to win the team because many people are used to work with paper, many are all, and now introducing a digital instrument, you want the people to feel easy with working with these instruments, right? And so you need to win the team and you must not forget about that.
Yeah, an important change management position to remember there. Also, I think we have to acknowledge kind of the wider economic environment that we're in at the moment. Obviously, we're in an era of much higher interest rates compared to the previous decade. Dominic, what impact is that economic position having on corporate supply chain management in the context of this digital trade discussion that we're having?
Well, it's certainly focusing the minds, Ben. Geopolitical headwinds have triggered significant rises, particularly in input cost inflation in most supply chains, to levels not seen in probably a couple of decades or more. And that is making supply chain stability and access to working capital of paramount importance to businesses up and down those supply chains. As a result of these rising costs, and with the global trade finance gap also rapidly escalating, increasing by a staggering $1 trillion in the last 4 years to 2.5 trillion. And for those not aware of what the trade finance gap is, it's a measure taken every year by the Asian Development Bank, actually, and other leading businesses involved in this domain to estimate, what amount of global trade fails to get finance. And, that's a staggering figure if one comes to think about it. So steps absolutely need to be taken to facilitate corporate access to available pools of liquidity, because again, as I think many people on this call and would know, that it's not that there's an absence of liquidity, it's matching that liquidity with the areas of demand. How to go about that? For most businesses, the supply chain finance solutions that exist today are far from ideal. Unfortunately, they're typically rather siloed, with corporates who have free cash using dynamic discounting programs to make early supplier payments, using those internal sources of funds to do so, and separately external liquidity being provided by banks that are often less willing or able to take on the perceived risks or the KYC costs of all but the largest suppliers, something that Enno just there alluded to. And that leaves many businesses in supply chain tails overlooked. Last but by no means least, as we look at this from a an inflationary or cost analyst perspective, many supply chains are funded from what I would call the weakest link in the chain, normally smaller suppliers with the tightest balance sheets, with the cost of finance filtering upwards through those supply chains as they progress. And consequently, in long supply chains in particular, that often involve negotiated payment terms and deferred payments between buyers and suppliers, that places significant strain and ultimately additional cost on businesses' working capital.
And Chris, is there also an educational challenge here in kind of ensuring that corporates are aware of what's possible in the digital trade space?
Yeah, it's not just corporates. I mean, I think that the whole trading system has operated in the same way for 200 years. The processes are almost identical. The paper behind it is almost identical, and sort of documentation is just layered up year on year for that period of time. It's not a surprise, and it shouldn't be a surprise, that we're all now saying we've got to get this trading system fit for purpose for the 21st century, and of course that means going digital. So there's sort of the two big challenges are, first of all, mindsets and awareness. You know, being aware that there is another option here. The evidence is really compelling, but it's about educating businesses and getting that knowledge and information out into the market. Because from my perspective, this is a bit of a no-brainer when you look at the numbers. And I think also, moving away from the sort of habits that have been associated. If you look at the system as it is at the moment, what we're proposing here in terms of digitalizing trade documents, ultimately this is about moving to data and away from paper. Let's be honest and frank about that. But nobody in their right mind would design a trading system as it stands today on paper and do it in digital form, because it's much more secure, much faster, much more efficient, and it certainly unlocks a whole range of interesting benefits for particularly corporate finance teams to gain profitability and have much more agility when it comes to liquidity as well. So it's all about awareness. It's all about providing case studies, what does success look like, in order to then show the way. But I think what we'll see is an exponential curve, is my suspicion, as more companies become aware of the benefits. This won't be a sort of trickle for the next 10 years. Because the numbers are all enormous. So it's more about awareness, number one, and the same for governments too.
Fantastic. And obviously we're thinking digital, so we have to think about technology as well. Enno, what types of tech tools should corporates be investigating to take advantage of digital trade? For example, could they run all this from an existing ERP or TMS that they're using?
Well, maybe immediately picking on Chris's thought, if you just continue with what you have, you will likely not see the benefits of the digitization, right? And also, we're at a very, very early stage of that digital adoption. And whether it's trickling or exponential, we're definitely early. So it seems likely that a journey within a corporate or a treasury team within a corporate has also just begun. And in light of that, you might not exactly know what you want in 2 years down the road, right? And we were discussing different goals that you can achieve with this. So you might start with one and then want to add another goal or want to achieve yet another goal. So anything that you do with respect to selecting a platform, you should have in mind that it should be holistic. The platform should be open and easy to use. Why the three? Well, if you choose a platform that is holistic, where you can select multiple targets to achieve with the same platform, and you don't need to go through yet another platform selection process just because you want to achieve another target. So it should provide robust support for a broad range of business use cases or instruments that you're using within your organization, rather than selecting a one-trick pony. So you might do a digital letter of credit, a digital guarantee, or digital promissory note, digital bill of exchange, right? You don't want one solution per each of the use case. The second element of the openness, assume you've done your platform selection or your tech selection process. The nature of trade, that is, you're trading with someone else.
Mm-hmm.
So it's highly unlikely that you will convince all your counterparts to choose your solution, right? So if you want to trade and if you want to, again, seize the benefits of this, it's almost imperative that you choose a solution that is open to connect to the solution of your counterpart. So that openness needs to be in terms of architectural design, it needs to be in terms of support from the vendor, and it needs to be in terms of easiness to connect with relevant third parties. And an indication of any solution being as open as that is like on the mobile phone, right? If there is an app store, it's open. So if there is already an existing or beginning partner network with the solution that you're considering, it's a good indication that you choosing it might actually be a low risk. Well, and finally, and that again picks up the idea of Chris on the data, the hurdles for implementation that we were discussing actually urge you to choose a solution that has an outstanding user experience. And I don't mean just a nice looking UI, but a true user experience. So actually reaping the benefits of working with data, so that working with that platform is not only easy to process the transaction, but the platform might actually provide you insights into what you're doing or what you're not doing, what you're missing out, what your counterpart is doing, what is the market doing, what are you comparing to the market, so that all we know from large data platforms, right, that you somehow get guidance on top of getting your business done, right? So looping back to your question of can it be done with an ERP or TMS? Well, I don't say no, but that would require these systems to significantly improve their, say, coverage.
Great insights there, Enno. Thanks for going through those. Also want to look at kind of processes. Dominic, I'll bring you in here. Are the processes in the digital trade ecosystem radically different to what came before, or is there any sort of level of familiarity that can perhaps help treasurers and other corporate functions get up to speed quickly with adoption?
It's a great question. I mean, whilst digital negotiable instruments are potentially transferable for businesses, the critical thing is, and Enno's just perfectly referenced this, is to ensure that that digital transformation isn't disruptive to well-established financing or operating flows. Any barriers that are put in place towards that adoption, I wouldn't even call it barriers, hurdles, are going to make that transition more challenging. So, we've referred to use of data, but also interoperability, which the law very much drives towards, which is a fantastic thing. So, vis-a-vis in the world of supply chain finance, what's critical to note here is that the negotiable instruments in their paper form, so bills of exchange, promissory notes, I'm thinking about mostly, they've historically been used in both documentary and structured trade for quite a while, not so much used within supply chain finance. But that can readily change, because what one's talking about here is effectively substituting, as part of a financing process, invoices for these negotiable instruments that are more robust, unconditional, and independent. Critically, as many will recognize, they're free from performance risk. But until the recent legislative changes that we've been discussing, they suffered from needing to be in cumbersome paper form. And the atomic nature of digital instruments will address those previous challenges. So where are we at today? I think the passing of the ETDA provides a perfect opportunity to use digital negotiable instruments more widely as a means to improve working capital and earnings by delivering financing flexibility to existing frameworks. Better access to liquidity, as I was referencing earlier on, to small, medium-sized enterprises, enhanced data security, as well as tapping into and attracting additional liquidity from non-traditional sources by accessing a broader range of financing partners, typically non-bank investors who welcome and most certainly will benefit from the transferability or innate transferability of these assets. Digital negotiable instruments also, or solutions based on digital negotiable instruments, offer independence from restrictive, non-fungible legal frameworks by using standardized payment and financing instruments. And they enable payment terms to be extended without the need to change or renegotiate underlying supplying contracts. So a number of global businesses are already looking at the possibility of using digital tools and platforms to switch seamlessly from one kind of electronic trade document to another across the same supply chain. And we welcome further drives in that direction. A good example would be the use of an electronic bill of lading representing title being exchanged for an electronic bill of exchange or promissory note once goods have arrived, and triggering a payment or a financing from a bank. And we undertook, in partnership with another platform, exactly that exchange of digital instruments between Singapore and the UK under a test use case sponsored under the umbrella of the pilots being sponsored by the ICC earlier this year.
Fantastic. So it's great to hear, pilots and how the whole ecosystem is starting to connect in such a positive way. Chris, I want to bring you back in and kind of touch on something that Enno mentioned in his previous answer, just really looking at how much focus should corporates have on systems connectivity and interoperability, and if what other considerations you think corporates should have when looking particularly at investing in technology in this space.
The number one piece of advice here is interoperability. The future is all about information moving in standardized formats across systems and platforms and between actors. That doesn't, by the way, mean free sharing of data. We're simply talking about existing data that's on paper, transacting and flowing freely in a digital environment. It's all about that. So at the moment, you've got sort of three layers of trade. You've got the finance layer, then you've got this very bureaucratic paperwork layer, which is where a lot of the cost is, obviously, and then you've got the physical shipment of goods. As you remove the paper, that gets replaced by data, and those three layers all collapse into one. So the future is all paperless. It's real-time transactions, as you can see from the evidence in the Seizing the Moment report. You're transacting in an hour or less. That gives you a sense of the kind of speed of what's happening here. And importantly, that information can move around. It's not just about documents of title. This is happening across borders, through trade corridors, single trade windows, government border systems. In the UK's case, it's fully holistic. We're all working together across public and private sector systems to make sure that this data can move around more efficiently. There was a really interesting report done by the UK government called the Ecosystem of Trust Evaluation Report. And that was looking very much from the government perspective, where there are equally massive gains here by simply using data more efficiently. About 70%, 80% of the data and information asked by governments is just all repetitive because it's all on multiple forms. Once you move into a data environment, there's a tremendous opportunity to radically simplify the amount of data requirements. And again, you can see that in the Seizing the Moment report, where data requirements have dropped 800%, to give you an idea of it. And that's just simply because we're using data more smartly, it's moving more quickly, but it's all about interoperability and connectivity. And just finally to say, in the context of interoperability in trade, it's seen as new. In the context of business, it's not new at all. We had container standardization in the 50s, we had ATM machines in the 60s, Apple and Microsoft, standardized their operating procedures in the 90s, and then we had the Android revolution in the 2010s. So it should be no surprise that we are having this conversation around trade, which has been notoriously bureaucratic and slow and inefficient for decades. Now's the moment to make this happen.
Fantastic. And just to let viewers know, there's a link in the chat that you can find the report that Chris is talking about. So I do suggest that you go and have a look at that after the webinar. And also, while you're here, do use the Q&A box. Our panelists are furiously typing away answers to you, but we will have a little Q&A section if there's any they haven't written an answer to coming up a little bit later. So get your questions in for our excellent list of panelists we have today. Chris, I'm going to come straight back to you, and let's have a look at some of the benefits here in terms of once a corporate has invested in technology for digital trade, what are the headline benefits that you think they might expect from this adoption?
Well, just put a little bit of context in here. In 2021, we did the economic business cases at national G7 level and Commonwealth level, actually. And the numbers at the time were, in the UK's case, 25 billion in SME trade growth, 224 billion pounds in efficiency savings, an 80% reduction in trade transaction costs, and 1 billion in additional trade finance. And then that multiplied up to 9 trillion in the G7, another trillion in the Commonwealth. So that's at least 10 trillion we're talking about here. So forward track now a few years, and the law is now in place. The numbers are extraordinary. You know, you're talking about 15% increase in profitability, trade flows doubling with SMEs, transactions in hours and minutes, data requirements dropping at 100%, shipping costs down 18%, logistics, costs down, similar figures, operational costs down. These are huge numbers. To put some context on it, when the WTO, World Trade Organization, negotiated the trade facilitation agreement, that was basically the agreement to enable governments to now digitalize customs and trade facilitation back in 2013. They were talking about a 14% reduction in trade costs. We're talking about an 80% reduction in trade costs, and all the evidence is supporting that information. The challenge a bit for corporates is this breaks into basically 4 lumps in terms of the cost, in terms of the benefit. The finance benefit, cheaper borrowing and lending, improved liquidity, you've got compliance, less fraud risk, faster verification times, authentication, LEIs, by the way, somebody's made a comment there, 100% important to that conversation, and obviously greater transparency. All the efficiency gains of faster border waiting times, faster over the border processes, reduced bottlenecks, but also importantly, sustainability, which we'll probably come to in a little while. This is the enabler to give us the transparency and the data we need in order to deliver our scope 3 objectives, which everybody is finding challenging in terms of sustainable global value chains. So the benefits are massive. Our simple ask from corporate finance teams is look at the evidence, absorb it in the way that you feel fit for your company, but look across the business. And that's why we're coming to corporate finance, because we think it needs to be centrally looked at. The benefits are falling across the business. It's not just customs, it's not just procurement, it's multiple. And that's where the significant win is, by capturing all of it. And it's all possible. There are no legal barriers to any of this at global scale now.
Some staggering efficiencies and cost savings that you've mentioned there, Chris. Enno, let me bring you in. What beneficial impact might the digital processes enabled by technology adoption have on the people that work in the business, do you think?
Well, bringing the people dimension is important, yet just reiterating on what Chris said, despite the numbers, I think that implementing digital trade instruments is almost the only case that has such an outstanding ROI that it is really that no-brainer move. No-brainer move, making it also a low-risk move for those people advocating the move to digital instruments within organizations, right? Now coming to the people dimension, because sometimes change isn't happening because people simply don't dare to provide the submission to say, let's go digital. So taking it to a yet complete different dimension, right? Over the past 30 years, the trade finance job has been more or less the same, right? People have used the same instruments, the same processes, the same paper, and in very many cases, even the same people within the teams. And while in other parts of the company or the organization, innovation will have taken place, and as it's been mentioned before, in the payments and in other areas, digital processes have taken space. The trade finance teams slightly turn towards being the old-fashioned folks that eventually are perceived to prevent business rather than supporting it. And prevent business due to the high cost and the slow turnaround times that have been mentioned before, right? So the young talents will have moved to other departments and not to the trade finance department. So the average age and the average tenure in the trade finance team is only rising. Now with adopting digital processes, that has the power to turn that pattern around completely, because all of a sudden the trade finance teams aren't the ones, or will be the ones that will be adopting latest technology and working on the most recent legal framework that we've been hearing about earlier. And all of a sudden, these teams can actually boost efficiency to these, say, stunning levels and gain senior management attention and ultimately more visibility on what they actually can contribute to the corporate's business. Simply imagine that if you turn around a 1-week process to a real-time digital flow, right? Your sales teams can win critical bids. Your treasury colleagues can manage that working capital at far higher frequencies, right? All the way to your facility manager can actually scrap the old physical vault in the basement. So using digital platforms and digital trade instruments actually makes the trade finance teams, well, eventually a bit of the hero that they deserve to be.
Fantastic. Be the hero that you deserve to be. A lovely message. Dominic, let me bring you in and let's think about suppliers a little bit here and the relationship that corporates have with their suppliers. Do you think adopting digital trade technology and processes could generate perhaps a loyalty bump for corporates with their suppliers?
Absolutely, it can. And, I love Arno's point about let's make procurement and treasury teams the heroes that they deserve to be. Undoubtedly, legislation and the whole digital agenda offers an opportunity to transform businesses' cash flows, strengthen supply chains, deliver operational efficiencies and enable that access of deeper pools of liquidity. So, from the perspective of both buyers and suppliers, there can be, to a buyer, most certainly a very positive bottom line contribution through using these types of processes. A typical supplier early payment programs using digital instruments can result in a annualized net benefit of anywhere between 1% and 6% of the costs of goods by leveraging the difference between financing costs between buyer and the suppliers, what I referenced earlier, what we call inverting the supply chain finance pyramid. So what I was referencing earlier in terms of that cost of supply chain, the financing costs being embedded from the bottom up, that can be turned around and funding can be distributed, what's commonly being referred to as deep tier financing from the top down, which is potentially hugely advantageous. And furthermore, the difference between financing using digital negotiable instruments that are enforceable under statute law, as we've been referencing, they can be financed as a commitment to pay, a binding commitment to pay through their issuance at 100% of their face value, compared to 85% of the value typically advanced against accepted invoices in many countries, particularly in cross-border transactions. That's because of that removal of the underlying performance risk from the separation of the performance risk from the financing transaction. And that's a huge advantage. That's the additional 15% or so of cash to hard-pressed suppliers. Add into which, the whole cost efficiency, the issuance costs of digital instruments. Chris and I were referencing these pilot transactions that had taken place under the umbrella of ICC UK. Across a number of those, it's estimated that the issuance cost of digital instruments are at least a third of the cost of managing documentary flow in more traditional ways, depending on market dynamics. In some instances, it was estimated that those cost savings were as much as 60%. I mean, that's, again, obviously transformational. Absolutely key to suppliers in terms of timeliness of payments. And I referenced this a little earlier on in our discussion, vis-a-vis the atomic nature of digital instruments, data-led digital instruments, as they can be exchanged in close to real time, and that expedites financing processes by as much as 10 to 12 days, sometimes more, and that enhances time to revenue as well as further driving those operational efficiencies.
Thanks, Dominic. And I do want to also touch on sustainability. Chris, you brought this up, and as a topic, sustainability often goes hand in hand with digitalization for corporates. So how does the sustainability angle fit into what we're talking about today from your perspective?
Well, there's the obvious that gets talked about, which is removing all the paper, 4 billion pieces of paper flying around the system. Let's get rid of all of that and stop chopping down the Amazon would be a good start. But actually, the bigger win is much more on the data side. You know, it's about having accurate data to inform decisions on what is sustainable and not sustainable for decision makers. So there are key data sets at the moment that are just buried in mountains of paper, what the goods are, where they're from, who's paying for them. You know, these are really important in terms of integrating those data sets with more broad ESG data sets to give decision makers total accuracy. And that also poses interesting policy questions to governments as well, that once you get that sort of transparency and accuracy on your visibility across your supply chain, then you can potentially start to develop policies that actually incentivize sustainable trade, i.e. potentially reducing tariffs and costs and duties, and then obviously aiming to mitigate where impacts are made. But most carbon emissions are all falling in the supply chain, and that's why the supply chain piece is so important. And quite a chunk of that is in the movement of goods from A to B. It's not just about the impact on the ground where they're coming from, i.e. produced. It's the movement from where they are to where they're going. That's at the moment a little bit of a black box, but that gets solved much, much faster when you start moving into the data environment. I mean, it's worth noting, I was at COP15 in Montreal last year, and you know, I think what you see in these global negotiations around net zero climate, we've got COP28 going on at the moment, and then COP15, 16 next year, which is all about biodiversity and nature and the environment, is you've got people who are negotiating commitments, which are quite right. We want to, obviously the big prize here is a sustainable global economy for the future. But what they don't realize, because they're not trade people, is just how unfit for purpose the trading system is. We're not fit for purpose to deliver that goal. And yet companies now are starting to see, you know, a wave of regulation coming in from government saying, you must do this, you must do that. We're seeing it in Europe. We'll see a lot more of it around the world. This is one way to mitigate against some of that and reduce some of that risk. The better data we have, the better quality of reporting, the more accuracy, the more able we are as businesses to demonstrate to governments and our stakeholders, investors, that actually what we're doing is sustainable, and we can prove that through proper use of data, which is very, very difficult at the moment with all this fragmented paperwork in the system.
Absolutely, absolutely. Okay, well, we've talked a lot about the challenges, the obstacles, what the technology aspect is, and the huge range of benefits that there are for kind of embracing digital trade. So let's kind of close out the webinar by looking at how treasurers can get started with digital trade. Another one of our LinkedIn polls showed that 43% of treasurers are either very likely or likely to implement digital trade documents in the next 12 months. So Enno, how might treasurers look to get started with digital trade from your perspective?
Well, actually, that feedback is the right starting point, right? The decision making within the corporate treasurers to say, I want to do it, or we as a team will want to do it. So that I was saying, right, where there's a will, there is a way. So once you're there, and we discussed that earlier, you need to agree on what are the targets that you want to achieve with digitization. And also part of the feedback was you can aim for business growth or optimizing your working capital. You can go for cost reduction. You can go for quality improvements in terms of data, all the way through job enrichment or sustainability goals, sorry, that you want to achieve. And these are very different targets and will guide to different routes for implementation. So once you set the targets, it is recommendable to start with a clearly defined use case that is relevant and achievable. So relevant in terms of it needs to be relevant for your business. And we were discussing digital instruments of title and the various use cases. So if you do digital guarantees, or if you do a lot of guarantees in your business today, pick a use case that uses digital guarantees. If you do use or have experience in invoice-based receivable or payables finance. Choose a use case that makes use of a digital prom note or a bill of exchange. Achievable in terms of, don't set the target for perfectionism. It won't work. It's rather recommendable to choose a use case, say, with a friendly counterpart. So a buyer or seller that you used to work with and that is also looking towards digitization. Mm-hmm. Choose a legal framework like the UK or the Singapore law, which have relevance in the trade and where transactions can immediately go digital because it's in the national law and does not require a rule book. And start with an easy-to-use platform that gets you to 80% of the goals with 20% of the effort. And the final recommendation is, most importantly, start.
Absolutely. And I like the kind of work smarter, not harder message that was in there as well. Dominic, data is obviously a huge part of the digital trade issue. And there's a lot of data that exists already within an organization and within the Treasury Department itself. So how important is it for treasurers to harness that data that they've already got?
It is absolutely important. Enno brilliantly referred earlier on to the power of data across businesses and across their supply chain networks. But we have to recognise that we're operating here in an environment of instruments, but the source feed for these digital negotiable instruments, or negotiable instrument even not in digital form, is data. At the end of the day, digitizing that process actually makes that transfer and that end-to-end auditability up and down and across supply chains that much more straightforward, again, assuming that the right partner system has been adopted. And most digital trade technologies, including ARKIT's Trade Secure solution, is specifically designed to be easily consumable by businesses ranging from multinational corporations to SMEs. And we've referred often now on this webinar to that interoperability that's not only with back office ERP systems, but also with banking and payment platforms. So how to get going, how to pick up on that impetus that Enno has just left us with. Well, in order to start using digital instruments, the process isn't necessarily that difficult, particularly in the field of finance instruments, where the stakeholders, and I'm talking about the relevant parties within a transaction, not necessarily the broader range of stakeholders within businesses themselves, but to get moving with a digital promissory note, for example, you need a willing buyer, a willing seller, and a willing financier. And that should be fairly straightforward to engage with, particularly sort of given the noise levels that are rising regionally and globally around the use of these instruments. And those counterparties can agree the both potentially operational, but more importantly, the financial parameters within which these instruments are going to be used, and then press forward to exchange invoice and payment data either via digital upload or via simple CSV file exchange if necessary, in order to kick off a process. Then once the instrument has been created, again, I reference that full visibility of the transaction chain, which is critical, and that's particularly critical from a potential financier's or bank's perspective. They are going to look and analyze not only the instrument, but the underlying data, and determine whether they want to purchase that instrument. And again, much easier actually in reality to achieve that with a digital process, not only operationally, but giving that underlying visibility that to the transaction data that answers many of the inherent not only performance but KYC challenges that financiers are faced with, as opposed to more traditional and cumbersome processes. So the time is very much now to get adopting. That process is not difficult.
And one of the challenges we spoke about earlier and touched on is kind of the silos between different departments within an organization that are all connected to the supply chain and trade area. of business. Chris, do you think treasurers can help drive a strategic understanding at the C-suite level about the importance of the connectivity between those different departments to really make the most of this opportunity?
Yeah, sorry, I'm busy multitasking here, answering questions at the same time as listening and answering. Yeah, look, I think corporate finance teams are essential. So as we've got more into discussions with the corporates, well, let me just row back a minute. At a global level, fragmentation is a massive issue here. There's lots of different actors in the system, which is part of the reason why change hasn't happened before. The ICC Digital Standards Initiative, its job is to help coordinate or solve that coordination failure at global level. Mm-hmm. At national level, it's exactly the same. Government departments all have different systems and processes. And so having a Centre for Digital Trade Innovation or equivalent is really, really important in creating that coordination point between business and government. But actually now we're getting into the corporate environment, we're finding exactly the same issue. And this is partly because trade cuts across business, government, global business systems in terms of trade as well. But we've identified at least 9 teams within corporates who are all beneficiaries of digitalization, and where the benefits, the economic benefits, are falling across the business. And therefore, the opportunity is to really grab, get your arms around it. And the only team that can really do that in order to capture all the benefits, we think, is the corporate finance teams. Mm-hmm. We also think the trump card here is finance. It's cheaper, faster transactions, it's cheaper borrowing and lending, it's faster payment terms, it's the ability to give you agility, that liquidity and profitability. Cost, of course, is massive here, which is why we're now specifically asking corporate finance CFOs to look at the evidence. We're trying to provide as much as we possibly can. For us, it's compelling, but we're super keen now to hear from those who are right, at the heart of this, and those corporate finance teams, to guide us. How do we help you solve the problem? But the transformational opportunity is huge. It just needs that central coordination and leadership from the top.
Thanks, Chris. We're going to skip the audience Q&A because we've done it on the text, on the Q&A section itself. Thank you to the panelists for doing that. 14 questions answered, which is easily a record in any webinar I've ever done. I acknowledge we're over time. Thank you for sticking with us. Let's just end on a very brief key takeaway from each of our panelists. Just one idea, one thought to leave you with. Dominic, let me come to you first.
I think, in summary, Ben, now's the time to get involved or risk, frankly, being left behind by the inexorable march towards digitization. Although introducing digital solutions to supply chains may seem to be a daunting task, as we've been discussing, it can be achieved in incremental steps and managed in a way that is in no way disruptive to existing processes. It's absolutely now time, in my opinion, for digital negotiable instrument to adoption to climb up the priority ladder, because as we've been discussing, the benefits to all stakeholders are obvious and far-reaching.
Fantastic. And Chris, well, what's your takeaway for us?
Yeah, quite simple, really. I think now's the time to take action, seize the moment, as the report says, I think says it all. And if not now, when are we going to do this? We've got the political winds behind us. There is no government pushing back here whatsoever. Legal barriers are being removed at speed now across the G7 and G20 and beyond. Now's the moment to transform the system. We should have done this 40, 50 years ago. For whatever reason, weren't able to. Let's do that now. But either way, we must move into the digital era. It's, having a trading system that's fit for purpose is absolutely essential to being successful in the future. All we're saying is these are the solutions, these are the opportunities. It's now or never.
Brilliant. And Enno, a last thought from you?
Well, Chris said that we should have done that 40 years ago, that it sparked that as a picture of the best moment to plant a tree, right, is 40 years ago. And the second best moment is to plant it today. And it's similar to the trade finance digitization. Now, we haven't done it 40 years ago. We are doing it now. And we're at a pivotal moment now that the UK, which is one of the trade nations on the globe, has a national law that equates paper with digital instruments. Nothing more to say. Let's get started.
Fantastic. Well, that concludes today's webinar. Huge thanks to Chris, Dominic, and Enno for sharing their time and expertise and furious question answering throughout the session today. And thank you all for tuning in and sticking with us. Don't forget to visit the TMI website for a wealth of corporate treasury insights, including articles, news, podcasts, and webinar replays. But that's it for today. So thank you very much for joining us, and we'll see you next time. Goodbye.
Goodbye.